Welcome to the Explainer. Have you ever wondered how Wall Street actually puts a price on a promise? Well, today, we're going to break down the surprisingly simple logic behind valuing a commitment to do something way off in the future.
So let's just imagine for a second. Let's say you're a baker and you need wheat. You know for a fact you're going to need 1,000 bushels in exactly 1 year, but you're really worried the price is going to shoot through the roof. So how on earth could you agree on a price today for that future delivery? Well, that right there is the exact problem a forward commitment is designed to solve.
You can think of it like a financial handshake, one that's totally legally binding. One person says, "I'll buy," the other says, "I'll sell." It's for a specific asset, at a specific price, on a specific date in the future. And here's the kicker: no one can back out. This, of course, raises the biggest question of all: what is a fair price for that kind of promise?
To figure that out, we have to start with this one foundational principle that basically props up all of modern finance.
No arbitrage. Yeah, I know it sounds technical, but the idea is actually super simple. There is no such thing as a free lunch. I mean, think about it. If there was some way to make a guaranteed, totally risk-free profit, everybody would jump on it instantly, and poof, the opportunity would vanish. So the fair forward price has to be the one, unique price that stops this free lunch from ever existing in the first place.
Okay, so let's really dig into this. To get how no arbitrage works, we're going to build the logic from the ground up, starting with the simplest case we can think of.
Just think it through. If you want to sell me that wheat in a year, what are your choices? Well, you could just wait a year and hope for the best, I guess. Or you could buy the wheat today, at today's price, what we call the spot price, and just hold on to it for a year. But buying it today means tying up your cash, right? And that cash could have been sitting in a bank account earning risk-free interest. So the fair future price must cover the cost of the wheat today, plus all the interest that money could have earned. That's really the only price that makes you whole.
And here's what that logic looks like in a simple formula. The forward price, we'll call it F0, is just the future value of today's spot price, S0. And future value is really just a fancy way of saying we take today's price and figure out what it's going to be worth in the future if it just grew at that risk-free interest rate. This super simple idea? It's our core building block for everything else.
But of course, the real world is always a bit more messy than just interest rates, isn't it? So let's start adding a couple of new layers to make our model a little more true to life.
Let's go back to our wheat. If you buy it today to sell to me in a year, you can't just leave it in your backyard, right? You've got to store it in a silo, maybe buy some insurance. These are the costs of carrying the asset, and logically, you're going to want to pass those costs on to me in the final price.
So our formula gets a little update. The forward price now has to cover the future value of the spot price plus the future value of any of those carrying costs you have to pay. It just makes perfect sense. Any cost the seller has to deal with get added to the final bill.
Okay, so what about the flip side? What if instead of wheat, you were holding onto a stock that paid you a dividend or a bond that paid you interest? Well, while you're holding it, the asset is actually paying you. This is a benefit of carrying the asset.
So it just makes sense, right? We subtract that benefit from the final price. And just like that, we've arrived at the complete, totally intuitive formula. The fair forward price is just the future value of today's price, plus any costs to hold the thing, minus any benefits you get from holding it. Simple as that.
And this table here just lays it all out, plain and simple. Carrying costs, stuff like storage fees, they push the forward price up. Carrying benefits, like dividends, they pull the forward price down. It's just a perfect logical balance.
So here's the really crucial point. This elegant logic, it doesn't just apply to physical things like wheat or financial assets like stocks. It can also be applied to something as abstract as an interest rate itself. Now this, I know, can sound intimidating. An interest rate swap, it just seems like some really complex instrument that only huge banks would ever use. But honestly, at its very heart, it's built from the exact same simple idea we've just been talking about. And this just brilliantly pulls back the curtain. See, an interest rate swap is nothing more than a whole series of forward agreements, all just packaged together. It's a promise on an interest rate for the first period, then another promise for the second, and on and on. It's just a bundle of those simple forward promises we've already figured out. Okay, so this brings us to what might be the most important question of all. We know how to set a fair price when we start the contract, but what is the contract itself worth after you've signed it, once the market starts moving around? And this is the absolute key distinction between pricing and valuation. Pricing happens one time, right at the start, just to make sure the deal is fair. At that exact moment, the contract's value is zero to everybody. But valuation is a continuous thing. The second you sign that paper, the market moves, and suddenly your contract has a positive or a negative value.
So how do you calculate that value? Well, it's actually surprisingly simple. The value of your contract is just the difference between whatever the new forward price is on the market today and the price that you originally locked in. That difference is your potential profit, or loss, at the end. And to find out what that's worth today, we just have to discount it back to the present.
And there it is, the formula for that. The value of your contract today is the present value of that difference between the new market price and your original locked-in price. And present value just means we take that future profit or loss and figure out what it's worth in today's money. That's all.
Let's make this real with an example. Imagine you agreed to buy something for $105 in the future. Now, time has passed, the market's moved, and a new contract today would cost $111.35. Guess what? Your contract is now valuable. You've locked in the right to buy for way less than the current forward price. The present value of that little advantage you've got is a positive $6.27. And for every winner, there has to be a loser. The person on the other side of your deal, the one who agreed to sell to you for $105, well, now their contract has a negative value. They are stuck selling for less than the market price. Their loss is your gain, perfectly balanced, negative $6.27. It's a complete zero-sum game. So let's just quickly recap the big takeaways here. First, forward prices are always set at that one special level that prevents any kind of risk-free profit. Second, that price starts with today's spot price, but it gets adjusted up for costs and down for benefits. Third, pricing happens just once, right at the beginning, to make sure the deal is fair, which is why the initial value is always zero. And finally, valuation is happening constantly. As the market wiggles around, one side of the contract gains value and the other side loses that exact same amount. And all this leaves us with a final, much bigger question. We've seen how a simple promise gets a price tag and how its value can literally change in an instant. It really makes you wonder just how much of our entire global economy is just a massive web of these promises, all built on the shifting sands of a very uncertain future.